Hey everybody, welcome to this free edition of our Traders Use Group Weekly Roundup for the trading weekend in October 18th, 2024. I'm Preston Brent. Thanks for tuning in. Well, the bulls are on a rampage. The S&P and the Dow this past week all moved to record highs over the week. The S&P has been up 6 weeks in a row. It's the longest streak since 2024. So let's just kind of take a look at the week here. Let me just move a few things around on my screen, get the screen up for you. Take a look at how we've done this past week. Couple of other little side notes. The NRF, the National Retail Federation, expects 2024 holiday spending to grow between 2.5% to 3.5% from last year. And I will remind you that some stats are out that show 12 out of the past 15 times the S&P's posted two consecutive winning years, especially over 20%. It extended the advance into the following third year with an average gain of 7.3%. So as I've told our members, we're a bit stretched, which tells me that over the next decade through 2030, we're not going to see the kind of returns we've seen from 2010 to 2020 or even up to like where we are right now. One other thing, gold is hitting or it moved over $2,700 an ounce for the first time this past Friday. And, clearly given the high debt levels and future economic growth concerns, U.S. deficit, which is more than 6% of GDP, that makes sense for me. In fact, if we look at all central banks, all the global central banks, especially the major ones, the reserves that they're holding in gold has grown from 3% to 10% in the past decade, as I said. So central banks globally are saying that the next decade is not going to be that, it's going to be a lot of risk. And that's why we're seeing gold moving the way it's going. Okay. And here in the US, of course, with our deficit at 6% of GDP expected to grow over 2 trillion for next year, that is also going to be hard to start getting those numbers down. And both presidential candidates are not really talking about it, but we'll see how this thing works. I think we can do it through growth, increased growth, but let's see. Another encouraging sign for Q3 growth is the value of U.S. retail sales. It increased 40 basis points last month, and that was accelerating from 10 basis points in August. The September reading was slightly above consensus, but we're seeing strength in consumer spending, which is over 70% of the U.S. GDP right now. 10 of the 13 retailers in retail sales reported higher sales for the month. So that is a good thing. We did see industrial production drop 30 basis points in September, and that was from a 30 basis point increase in August. And we got also the final number for August. It was revised down a little bit as well. Initial jobless claims also fell unexpectedly to 241,000 this past week. And we did see a decline of 19,000 filings in receiving jobless benefits. Okay, so that's kind of where we're sitting there. I think it's just falling short of consensus estimates, but that's kind of where we're sitting. You can see for the week, all the markets were in the green. The Dow, S&P, NASDAQ, and the Russell all in the green year to date, double digits across the board. The PE ratio is a little bit concerning to me. You can see the trailing 12-month is over 25. That is really stretched, guys. The forward PE for the next 12 months is estimated at 24.15. So there's a lot of optimism in future earnings growth. Members, this Sunday evening, we'll go in a little bit more detail on that, but still, I think way too high. You can see the dividend yield, S&P dividend yields at 1.26, 10-year Treasury, still over 4%, just slightly under 4.1%. You can see if you look on there, the current VIX closed out the week at 18.03, so still elevated, and it's going to stay elevated through we get through the elections because there's a lot of different differences between a Harris and a Trump administration, primarily in the area of taxes and spending. So you're not going to see a lot of commitment for CapEx spending until they get a really good, clear picture of which administration is going to take over. But you can see the VIX, even though it fell a little over 11% for the week, The prior week it closed at 20.46. Came down a little bit. It's going to stay elevated. You can see the best performer for the week and for the year is still utilities, which gives this year kind of a strange pitch. It's a risk-off type sector, but with the electrical demands of AI, it shouldn't surprise anybody. Certainly doesn't surprise me. The worst for the week is also bringing up the rear for the year is energy. We did see that pullback in energy this week with some of the issues going on over in the Middle East. So all of that is stacking up to just tell me that the markets are stretched. They can still go higher if we have, remember the earnings bar for Q3 is relatively low. The banks came in, mostly did very well, primarily in the area of investment banking revenues like Goldman Sachs and Morgan and those that have big investment banking arms in the market. Those are doing very well. Um, Now, if we come over and we look at the European markets, you can see mostly in the green, the Euro stocks, which is a representation of 50 of the largest companies across Europe, was slightly in the red. Year to date, they're all in the green. The ECB this past week did lower its key deposit rate by 25 basis points, bringing it down to 3.25%. That's the first back-to-back reduction that the ECB's put out in 13 years. That's coming a long time ago. And the ECB president, Christine Queen Bee Lagarde, I like to call her, said that they've got a disinflationary process. It seems to be well on track, although just like the Feds here, they're reiterating that they're not going to pre-commit to any particular rate path. Although the financial markets look like, as they are here, expecting more rate cuts from the ECB. So that's helping goose the market a little bit over there. Their inflation came in at 1.7% in September. And that was a downward revision from the initial estimate of 1.8, well below the ECB's stated target rate of 2%. So all of that's pretty good, right? Now, over in the UK, they also had slower than expected inflation. So it seems to be, as I've been telling our members, a rear view mirror item for the past month or so. Markets are not as focused on that as they are on future earnings and economic growth. Over in the UK, their CPI came in at 1.7% year over year through September. That's the lowest it's been since April of 21. They had forecasted 1.9%. Okay. So all of that is looking fairly good. Their services inflation came in also at 4.9, so that's fairly low as well. So it's a several year low for inflation all across Europe, actually. Now, if we look at the Asian markets, you can see the Nikkei was in the red slightly. Year to date, it's double digit. China finally had a week in the green. Green year to date. Hang Seng, red for the week. Green year to date. A lot of that came off the Chinese stimulus. But let's go back to Japan for a second. Some of the Bank of Japan Bank of Japan officials, they're emphasizing that while all the prerequisites are met for monetary policy normalization, which means they've already gotten rid of their negative interest rate policies, but they want to hike the rates. They're saying they're going to do that at a very gradual pace. All right. So the yield on the 10-year Japanese government bond is actually up to 97 basis points right now from 94 basis points at the end of the previous week. Japan wants to get it right over 1%. Their core CPI showed inflation is easing in September. It's coming in at 2.4%. Remember, Japan, unlike all the other countries on this planet, have been trying to jack up inflation because they've been fighting deflation for 20 years now. So they are seeing inflation CPI easing back just a little bit, which I guess they like. Also, the Japanese exports fell a little bit in September to 1.7%. That's the first decline we've seen in Japanese exports for 10 months. A lot of that's reflecting weakness in China because China is one of the big importers of Japanese products. So we're getting that. And speaking of China, their Q3 GDP came in at 4.6%. Remember the goal that Xi had earlier this year was 5% GDP. They're not going to make it. So their GDP first pass Q3 came in at 4.6%. The consensus was 4.7, so it came in even below consensus, right? On a quarter-over-quarter basis, their economy grew about 90 basis points. We are seeing some bit of green shoots in the Chinese economy. Their industrial production came in at 5.4% in September. They were expecting 4.5, so that's a little bit of a growth, and their retail sales grew at above average forecast of 3.2% year over year, right? Annual inflation in China came in below consensus at 40 basis points. That's the lowest level it's been since August, okay? So overall, China is still struggling. That big, massive stimulus that they put in a couple of weeks ago, while it momentarily helped the markets, it's slowing it down again. They're going to have to see real fundamental growth because stimulus alone will not move that economy. Maybe short term, but longer term, no. So I think they're going to miss their GDP estimates for this year of 5%. That's what Xi wanted. They'll come in under 4.6, 4.7%, kind of what I'm seeing. What I want to do is shift the screen over. I'm going to shift it to the charts. Let me just show you a quick rundown of some of the key charts that I'm looking at here right now. First one up is going to be the E-mini S&P 500 futures. It'll take a couple more seconds to come up on your screen. So what you see here is this bar, which I use my system to generate. It uses a combination of Gann, Fibonacci, and time series. And it's usually about 60, 65% right on. And generally, from experience, it takes a long time for price action to move above that bar if it does. And if it does move above the bar, it usually comes back and settles in on the bar again. So I've had this up for quite some time. You can see here that the center of the bar is, call it 58.50. Now I've calculated some pullback points, 58.06. And right around 56.50. So these are pullback points that take us out over this next period of risk through the Federal Reserve meeting in the middle, early parts of November. You can see that we hit an all-time high on October the 17th at 59.2725 in the S&P futures, E-mini futures, up 23.16 intraday. Okay. We're well extended north of the 50 EMA and the 200 EMA. I believe the period of risk can bring us back down, fill this gap before we make another run higher. Now, I've been talking about a pullback now for about 6 weeks, but remember, momentum can continue us or carry us a lot longer and a lot further than you think, right? And there's just a lot of bullish momentum in the market right now. In fact, for me, as more of a contrarian, because I like to go to the other side of the playground, which usually works out all the time. When you've got strong momentum, you just have to let it run. It's kind of like when a fish takes your lure, and he starts running. You don't want to yank the lure. You just want to let him run with it for a while. So that's kind of what we got with the markets at this point in time. And of course, if we come down here and look at NASDAQ 100 futures, the thing I want you to note is we have the last all-time high we made in the NASDAQ 100 futures was way back on July the 12th. So that shows you that the markets are moving higher without the Mag 7. Yes, the Mag 7 are contributing, but we're getting more breadth in the markets as cyclicals and other stocks are taking some of the slack away from the Mag 7. And we're close to making new all-time highs in the NASDAQ 100 futures, of which the Mag 7 account for over 40% of the index value of NQ, or you could call it the Qs. This is the futures. But you could see here where a little bit tighter range to the 50 EMA and the 200 EMA, okay? And of course, if we come down here and look at the equal weight index, you can see the equal weight also made new highs on October 15th, this past week. So that does show and confirm that we're getting money rotating out of the Mag 7 into other stocks, increasing the breadth of the market. Now, notice as we're making this camelback move higher, just wave after wave. The MACD is getting a little bit weaker and weaker. All right. If we look at the RSI, you can see the RSI does not show some of the divergence that the MACD shows. In fact, the RSI is relatively flat, but it's near an oversold condition. So that does tell me that the markets are a little bit ripe for not a big pullback, more of a dip. And if we get a dip, I would let it see if it could run down to the 50 EMA, right? And that's not a big run. I mean, if I just measure it, just back of the napkin, I'll just do my ruler here and take it down. It puts us down about 3.5%, 3.6% dip. That's nothing in the scheme of things. And I could see us going down like over here where we got extended from the 50 EMA. We moved down to the 50 EMA. Intraday, you could see we closed below it. Sorry, we moved below it, but we closed way back up top. I would expect a pattern like this, okay? Now, because we're at a higher price, the pullback may be a little bit different. If we just look at the pullback here, it was about, you know, intraday, it was down 3.8% roughly, but we ended up closing right around 3%. So over here, that gives us a little bit more of the same, maybe a little bit more than 3%. But again, that's what I would expect in this next period of risk coming up through the Fed meeting and the elections coming up here early in November. So that's kind of what I'm seeing here. It just makes sense to me, working off some of these profits as a run up that we're seeing. If we look at the FANG index, this is a custom index of just the FANG stocks. Same thing as NASDAQ 100 futures. You can see here if I move it out where the last all-time high here was on July the 10th in the summer months. You can see, in fact, the FANG index has been pulling back a little bit this week. It hadn't been moving higher. So this does tell me that we are getting some rotation moving around out there. And then finally, let me just show you let me get the Dow here. Where's the Dow? I know you're on here somewhere. Here we go. If we take a look at the Dow futures, you can see the Dow futures also made a new high. Actually, it made a new high on Friday, the 18th. Intraday up 14.78%. Okay. So this past week, we got new highs in the equal weight SPX, the S&P, and the Dow. Okay. Everybody else did not. So the equal weight, though, is important because it is showing breadth is starting to spread out a little bit. And that'll help the markets when the Mag 7 pull back. Okay. And then finally, if we look at the Russell is moving up. The last all-time high in the Russell, or the last high in the Russell, was on July 31st, right? It was up 13.48. Now, one thing I'm going to spend time with our members on too, but I would remind everybody that the Russell, even though they started cutting interest rates, the Russell has not taken off. Should Trump win the election, which the betting odds makers say he will, then the Russell is a good place to park some money because I think it's going to take off, right? Taxes, he's going to reinstate the taxes. He's going to reduce corporate taxes. Interest rates, the feds are already on record as saying they're going to be cutting rates through next year. And that's all good for small cap. And I think you're going to see a rotation, a bigger rotation into small cap, and I think it'll take off even more. So these are what I'm looking at, from a macro perspective. And then, of course, if we come in here and we look at the 10-year bond, okay, I'm sorry, the 30-year, we broke this upslope and trend line. We came down, we tested it, and now we're back down again. So if we break this right here, which was the low, once we broke the line, we're going to go for a run. In fact, Elliott Wave is telling me that it could go much lower, which means interest rates are going to go higher. Okay. And the reason why rates are going higher, not only in the 30-year, but the 10-year, even though the Fed's cut by 50 basis points, is they believe the Feds are not going to be able to cut as quickly as the markets anticipate or are built in because of the nature, the hotness of the market. Because the fear will be that they can reignite inflation. And that is what's keeping the rates in the middle and the long end of the yield curve higher than you would expect after the Feds have cut by 50 basis points. Okay. And then, of course, if we come down here and we look at currencies, if we look at the US dollar, the dollar had a down day on Friday, but look at the dollar, straight through the roof. Why? Well, because the rates on the 10-year and the 30-year are going up. which means the Feds may be stuck and may not be able to cut as aggressively as the markets would like. That is giving strength to the dollar. The dollar just took out the 200 EMA this past week, and now it's going to do the requisite retest. If it retests and goes back underneath the 200 EMA and then goes up to retest and fails, then we're going to want to short the dollar to the downside or go long the euro. And let's just look at the euro, which is just the exact opposite of the dollar index. It failed the 200 EMA. Now it's coming back up to retest the 200 EMA. If it climbs back above the 200 EMA retest and it holds, then that's a good signal to go long the euro. Okay, but you can see we had a perfect short signal back over here on September 27th when we got that divergence in the MACD, and that was the signal to go short the euro index. And that means basically the dollar is going to get stronger because the euro index, the euro currency is about almost 58% of the dollar index. So that's a little bit about what I'm seeing there. And then, of course, we look at my favorite, the Japanese yen. We got long the yen way back over here. And now the yen is going to start to consolidate down in this area and it's going to make another move up higher. My longer range target for the yen is way up here. But we got to get through the Feds and see what the direction of the Feds and the ECB is going to be in November. And that the markets are suggesting the yen is going to go higher, which means the dollar is going to go lower. Okay. Same thing with the euro. The euro is going to get stronger. And then, of course, if we come down here and look at gold, as I said earlier, it cleared 2,700. It's right now sitting at 2737 or the intraday high. The high was done right on the 18th, right on Friday, right? So we have that high and and it closed right at the highs, right? The closing price and the high price right there. But it's setting up for a pullback. I do believe gold is going to pull back. It's going to give buyers an opportunity to come in and pick up gold at a lesser of a price. If I were to just mark it right there, that's where I think gold's going to pull back to, right around the 2,600 level. And then it's going to consolidate for a while, just north of the 200 or 50 EMA. Okay. And that would be a buy point. My original buy point was back over here when gold did that dip. It came down. I thought it would go a little bit lower, but it never did. And then that was my target. And as you can see, we hit my target and we bounced around at my target for at least a month, maybe a month and a half, came back down and retested my target before it took off again in early September. And now it's reestablished the run higher. So that's what's going to happen again. We're going to have that consolidation period before it runs higher. If we look at oil right here, there's more supply than demand in the oil markets. My original target here, it hit perfect. We did a retest. I think it's going to come back down here again. Remember, OPEC is projected to put more than a couple of 100,000 barrels of oil a day back out into the market. Saudi Arabia is afraid of losing market share, so they're going to turn the spigots up. And if growth starts to falter, we're going to see oil come back down because there'll be more supply than demand. And if Trump comes in, you're going to see oil also run much lower. So trades for Trump, you've got, if they win, you want to be long the Russell and you want to be short oil. I think it'll come back down because Trump's already talking about drill, baby, drill. And that just puts more oil in the market. So that's a little bit of what I'm looking at oil. And then, of course, if we come down here and we look at nat gas, I think it's going to go lower right here. I wanted to get lower. Actually, what I really wanted was a run up so I could short it, but it may not do that. It may just give it all up and come back down here again. Again, if Trump wins, it's going to come back down and test these lows that were made over here, which is a good thing. And then we're going to want to look at it going long. All right, everybody, that's a quick update on the markets for this weekend. Great football on, college football on this weekend. For members, I will see you Sunday evening at 7 p.m. If you're not a member, I highly encourage you to come in and check us out. Otherwise, have a great weekend, everybody. I'll see everybody next weekend for our free roundup. Members, I'll see you Sunday evening at 7 p.m. Ciao, folks.